views expressed in this podcast are the speaker's own and are not the views of This Week in Fintech or any other person or entity. The content provided in this podcast is for informational purposes only and should not be construed as legal, business, tax, or investment advice or a recommendation, solicitation, endorsement, or offering by me or anyone else for the sale, subscription, or purchase of securities or for investment advisory services of any kind.
Michael Tannenbaum, thank you so much for joining us. It's been a little bit since I had you on the OGs podcast with Nikki Glemis.
Yes.
That was a very fun episode. I loved recording that. You guys were great. You obviously have had quite the fintech career. So SoFi is when I met you. You were high up there, and that was early on in your career. And then you went to Brex, and I remember meeting up with you, and it was just you, Enrique, and Pedro, and we were like moving boxes into the, like, you finally had an office.
Right.
And now obviously Brex is like massive. And then you moved over to Figure. It was like a year, 2 years ago?
Yeah, about a year and a half.
And Figure's always been one, like I remember talking to Mike Cagney, the founder, very early on about this new idea and everything, blockchain, etc. And I feel like I've never fully understood what Figure does, especially because you now have like the two businesses essentially in it. So kind of like dumb it down for me, and let's use that as a starting point. What exactly is Figure doing, and how has that evolved from Mike Cagney's original idea around, what is it now, like 8 years ago-ish? To today, because I know you guys have expanded like crazy.
Sure. So I will answer that and clarify a few things in doing so. One is that it's really one company. So while it was split, it was designed to be one company. And there is a big blockchain element of what Figure does. And that's always been kind of Mike's vision. I invested in the company really early, actually. So I kind of have been a part of it for a while, coming out of SoFi. And the premise was always that, blockchain could be a meaningful improvement in capital markets, especially in areas like private credit, so mortgage, student loans, all the things we were experienced with at SoFi, where loans have moved throughout the capital markets, are owned by multiple people, and there's all kinds of quality control and verification. So that was sort of the original concept of Figure, and that's still the business today. So from that perspective, I think Figure has a very high, what you could call say versus do ratio. And that's something I'm very philosophically aligned with as well, which is like, execute and say what you're going to do and do what you say. So I think from that perspective, Figure is sort of one company. There was a period of time where Mike spun out a portion of Figure, recruited me to run that. And now we've merged those back, especially given the current macro and regulatory environment we're in, which is much more favorable to blockchain and people are more leaning in. You could almost say that like a year ago or so, if you brought up blockchain at a corporate board meeting, people would laugh at you. And now people need a blockchain strategy, might get fired for not bringing that up, right? And so that environment is why we recombine the businesses.
I mean, it's interesting just thinking about how the regulatory environment has shifted so much around blockchain and stuff too. Like I had David Marcus on this season of the Fintech OG series. And the last time I had seen him before doing that interview is when I was in DC, when he was just getting like grilled by all the politicians on Capitol Hill because everyone hated crypto, everyone hated big tech, etc. And it's just so wild to see how the market has shifted so much. How much of that do you think has played a role in the adoption of blockchain versus like finally getting really good use cases? Obviously, you guys were early on in establishing a use case that really worked, but I've been hearing about blockchain since I was in college in 2011. And it's just like all the banks are like, oh, like Bitcoin doesn't matter, but blockchain is the thing. So talk me through a little bit about now. It seems like everyone kind of, even if they don't fully understand what blockchain is, all these companies, whether it be banks or fintechs or payments, whatever, know they have to have some sort of strategy around it. So kind of walk me through what you guys are seeing.
Sure. And I'll answer that from the Figure perspective as well as a market perspective. So from Figure's perspective, we provide a embedded origination system and capital markets. And we've been I can't think of a company that adds more value in blockchain in the real world, right? Not sort of crypto for crypto's sake or blockchain for blockchain's sake than Figure, right? Very specifically, people use our technology to originate assets, largely mortgage, but also crypto-backed loans and increasingly small business loans. And they use our technology to originate these loans. They're, quote, tokenized, right? Because they're blockchain native, they're on a blockchain. The lien is perfected and all the trading happens on a blockchain. And when that happens, because the information is immutably put on the blockchain up front, there is significantly less quality control and diligence and costs for doing quality control and diligence. And you have like a much more liquid and homogeneous market for these loans than you would if it wasn't on blockchain. And so that's what we do. And we've been doing that prior to the sort of environment changing to be much more pro blockchain. And I think one of the reasons we've been able to do that is we've put blockchain in some ways in the background, right? We've made it technology. So from the perspective of the 170 people that use the technology or the 100 plus people that buy our loans in some way, yes, they're aware that it's blockchain, but they really think about it as faster, better, cheaper, rather than using blockchain. So for Figure, the current environment is upside, but we've been successful in an environment that wasn't as pro blockchain. For the broader market, and we have parts of what we do that are connecting to these areas, things like DeFi, stablecoin, right? Those are now becoming much more part of the financial services industry than they were for the last couple of years because there is more enthusiasm and regulatory support. So I would separate Figure from the broader blockchain industry, which in general has had ups and downs, winters and summers, and there probably will continue to be that element as the business evolves. And I actually think for lots of marketplace technology, if you were to go back to railroads and what was going on with railroad stocks or just early stocks in general, and you were to research some financial history, it's not like the New York Stock Exchange or penny stocks or all these things haven't had their own, share of issues as things normalize. So I kind of see from a more financial history perspective, what you're seeing with blockchain as relatively consistent actually with a technology that's going to evolve and proliferate.
I know Democratized Prime is one of your newer product launches. Where does that fit into the Figure ecosystem?
Yeah, so that is the main reason why I said we don't have two businesses, right? We have a consumer credit marketplace where people originate tokenized assets and sell them into our marketplace, and those things go together. You can't use one without the other. And then we have a digital asset exchange, right? So like a place where you could trade crypto, borrow against your crypto. But what we've done is we've combined those two and we've built a product called Democratized Prime that you referenced. And what it does is it offers borrowers like fintechs or mortgage companies that have assets and are looking for capital to borrow against those assets.
And this is more than just a mortgage. This is any sort of asset-backed lending.
Well, today it's primarily mortgage, but it would work for any kind of asset-backed lending. It competes with warehouse lines broadly. But as I think one thing Figure's done well to stand up marketplaces is you've got to sort of control one side. And so the side we can control today is the asset side, sort of the borrow side. And we're starting with Figure mortgage products, which there's a broad market for. And we're bringing on investors that want to invest in those products short term, right? Not buy them. We've already built a long-term marketplace called Figure Connect. I've referenced it. But now we have a short-term marketplace, Democratized Prime, and it broadly competes with warehouse lines, which is something that everyone, at least in fintech, is aware, people know what a warehouse line is. For the audience that doesn't, right, that's a short-term, typically special purpose vehicle that you set up that is bankruptcy remote, and you put your assets into it and you borrow from typically a Wall Street or investment bank against those assets, generally at a relatively high rate. And it is generally non-committed financing. And that's typically a two-party deal where it's just you and facing the counterparty of the bank. What we've done is said, let's make this one common marketplace where you just sign up to marketplace terms, right? You don't do legal and asset diligence with a bank. They're separated, and it's more of a market where you show up, you sign the platform agreement, and then you can borrow in an auction style against your assets. And like any disruption, there's going to be people who are like, well, I have tons of warehouse lines and they're so cheap and things are great. And it's like, sure, you're probably not going to be the first user of Democratized Prime. But in my experience in fintech, especially in the early stages, it's a big challenge to get this done, right? It's tons of legal fees. It's a really long process, and you're not getting a guarantee that the money's going to come. You have to sort of request it every time you want it. And this is a superior offering. And so we've started with people with our own assets, right? Assets that use our technology to originate. So our partners, and they can borrow more cheaply than they could in a warehouse line. And they don't have to go through the pain of the diligence and the legal process of setting up a warehouse line. They can use Democratized Prime. And so this is going to be a big thing. It's more, quote, DeFi than other products from Figure, because it's essentially a marketplace where you come on and you are not transacting with anyone. It's through a smart contract. So you're not transacting with us even. I mean, it's our marketplace terms. So it's more similar to some of the platforms out there that you might be familiar with, like an Aave or Camino or Base on Coinbase, right? Most of those are for crypto assets. We're doing this for what's called real world assets, right? Meaning loans that actually aren't just crypto.
Is this meant to, is the long-term goal for this to potentially replace traditional prime brokerage, or is it more of like a niche market? What are you kind of thinking, 5 years down the road?
Yeah, I mean, this is the largest and most scalable concept. And so I would say both. I think you could describe it as replacing the wholesale capital markets, which could include warehouse lines, commercial paper, and would also include prime brokerage, right? Sometimes people think about prime brokerage from the perspective of like an investment bank, meaning they think about the people that are prime brokers. But what is the service that prime brokerage offers? It offers, short-term liquidity against typically equities, right? But it's the same concept. And I think one of the powers of blockchain is this concept of cross-collateralization, which is not how the existing market works, right? Where you can get credit for having assets, and then you can use the credit for that asset to buy other unrelated assets, where typically in prime brokerage today, you can only get credit to buy the same asset. And it shouldn't necessarily work like that, but it does. And so I think there's a big future in the short-term capital markets on blockchain for both cross-collateralization reasons that I just mentioned, but also reasons I was mentioning around the legal documentation and diligence that goes in to standing some of these things up, which is just a big barrier.
That makes a lot of sense. I mean, fintech in general, highly regulated space. So adding in like an additional layer onto that sounds like anything you want to do right is going to take time. And is that part of the reason that you guys launched this now? It was just like the right moment. You've been working like regulatory for a while, and it all sort of came together?
Yeah, I think the environment is definitely favorable. I think also Figure is at a scale. So we launched Figure Connect, which is kind of our pure marketplace where originators can control their production. They're using their licenses and their balance sheet to originate our assets and selling them into our marketplace. We launched that in June 2024, and it's grown significantly. It's over 40% of the volume that we've done, in the most recent quarter. And so because of that,
does that surprise you? Would you have thought it would have been less than that?
Well, I like to bet on myself, but I mean, I think like going from 0 to 40, by the way, also growing rapidly and at big scale, like that's very hard to do. I think part of that is because it makes the incentives align for partners, so they want to do it. But because we were able to do that, if you just think from the perspective of an originator, right, someone who uses Figure technology, well, now they're in control and they need to go get their own warehousing, whereas we used to provide that for people. And so because people need this is actually like a real problem that our partners face, which is sure, the biggest ones have lots of people that want to do warehousing with them. But the smaller ones are like, look, it's taking so long. It's hard to get a warehouse line. People want us to personally guarantee it, whatever it is. And so we see this problem in the marketplace. And because there's some standardization in Figure assets, we can start doing this against the Figure mortgages, and then we can expand to other asset classes. And so I think, we have this experience standing up marketplaces, and this is part of that. And it's a real need and demand that our partners face.
For the segue, my next question was, what other kind of real world assets do you plan to onboard beyond things like HELOCs and mortgages?
The assets that will probably come most quickly behind and, are kind of in the pipeline are of course going to be those that most resemble what we do today. That's the natural way things expand. And so you have a lot of mortgage products that are not sort of traditional mortgages, which is what we mostly offer, right? Like, just single family or 1 to 4 family, collateral type for 30-year amortization period. But you have things like fix and flip, or sometimes called residential transition, or HEI, which is like, a home equity kind of derivative. And these types of areas where there are people doing interesting things, there are fintech companies, and there's not a standardized capital market, that's sort of one area, because you also still get the security of the home, which is, one of the helpful things that moves our marketplace as investors are comforted by the fact that there's a home at the other end of this, right? You also have things like auto, where there's also an asset behind it. And then you also have, interestingly, and I mentioned this before, a lot of interest in the small business space. Small business is a big asset class, and it has the SBA, which in some ways plays the role of like a Fannie Mae, right? In that there's some government entity kind of regulating things and standardizing things, but then around that, there's innovators. And so we see all these kind of market dynamics playing out and bringing demand to borrow. And we just have to make sure, one, we vet this out and do it correctly. And two, we actually have the AI technology, which we're building. That technology validates that because remember, these people don't use our origination system. They're third-party assets. And that we can validate that they did their underwriting in accordance with their guidelines. And so we kind of like scan the documentation and compare it to the credit guideline and confirm that, this was done according to the way they said it will be done. That's not to say that it won't default, right? And that's actually consistent with what Figure does, right? When we are representing to our capital market buyers, we represent the process because we don't use people, right? So we're like, the models say this, the bank account says that, this is like the way that it was done. And we will do similarly with third-party assets.
Talk me through like delinquencies and defaults and stuff like that. What does that look like on your platform using the blockchain? And, you have, I believe it's called the Digital Asset Registry and stuff like that.
Yes.
There you go. Walk me through that part of the business a bit.
So what DART does, DART is Digital Asset Registry technology. You could call it the quote tokenizer if you wanted to use that language, which is just hot right now. But what DART does is when a loan is made, a loan is a digital asset, at least with Figure, right? It lives digitally. That loan has to be registered with the county, and the lien has to be registered with the county as well, right? Because it's a mortgage. And so DART will do that, and it will register the lien in the name of DART. And then what happens is now the loan is a blockchain native asset. It's on blockchain. And the first time it's traded, that's a blockchain transaction. It's validated, right? Like any other blockchain transaction. And now the loan lives on blockchain, and it's constantly being, the county is always updated because it's registered to DART, and that looks through to the blockchain. And so what that does is, one, it reduces all the like paper-based post-close or processes that you would do when you transfer a traditional mortgage. But two, it also confirms there's perfection to that lien, right? Only one owner of it. Because if you actually think about the way, to go back to warehouse lines are done, typical warehouse transaction, you'd send a CSV file of like the loans, and then people send you the money, and like no one really knows that you didn't send the same CSV file to someone else, right? And that was a big problem in '08. So that is something that, blockchain confirms. Another thing that we do, you didn't ask about this, but I'm just going to throw it in there, Julie, is that when you do that in stablecoin, if you settle in stablecoin, you can actually release the money only at the same time as the loans are released. Whereas we all have understanding, you were just telling me about this before, it's like when you send a wire, you're like waiting around, like hoping that it comes. And like I've spent too much time waiting around for wires, not that long, but when they're coming, you want them, right? And so that's a big thing. But if you're a bank and you've sent out a wire and not yet received the loans, like that should happen atomically, right, at the exact same time. And so those are the kind of small things that Figure does that in aggregate actually add real value to the capital markets. So that's kind of part of what you asked. I think the second part of what you asked is just more around like credit, right? And with credit, I actually think this is something that I've learned from Mike. He always identified that in financial services, the mass affluent space is a great space. And if we go back to like 2017, I joined SoFi in 2014. At the time, a lot of fintech innovation was focused on the lower credit segment, which is fine, right? But at the end of the day, Mike said to me, he's like, it's harder to make money in that segment definitionally because the borrower base has less money. Doesn't mean that you shouldn't try there, but a disproportionate amount of attention was spent there. And I think one of the reasons Figure's been successful is we've actually made credit not a huge factor because we're serving a more mass affluent base. Not that mass affluent people can't default, they can, but we've pushed innovation in the capital markets because we've taken credit for the most part, not as a factor. And so if you're a buyer, you're like, okay, I really want this loan. It's a good loan. I'm not that worried about default. So maybe I'll put up with other like blockchain things that are a bit different versus if we were like, hey, this is like really cuspy. And by the way, do it on blockchain, that would have been harder. So I actually think because we serve more of a mass affluent, owns a home by definition, at least for our mortgage product, typically higher credit customer, and there's 35 trillion of home equity outstanding. So there's a fair amount of cushion. I think that has actually enabled the innovation in the capital markets because we've removed credit as a factor. In many ways, Fannie Mae sort of paved that path, right? Because they provided this guarantee and then built this like innovative capital market that does all these other things because they removed credit from the picture as well.
Got it. So how do you grow liquidity on each side of the market then?
You grow liquidity through homogeneity, meaning you build a similar asset across these 170 partners. You build it at scale so people want it, so they can trade it, so they can securitize it years later. And then because of that predictability and that scale and that homogeneity, when someone's buying loans from Figure's marketplace, they're buying across 170 originators, but they don't care. And nothing else really works like that except Fannie Mae, right? It's almost as if Brex, Ramp, Navan, and Rippling all used the same sort of technology and credit policy to originate loans. There would be a lot more liquidity in those loans and costs would go down for everyone. I mean, good luck coordinating that, but I guess I could throw my hat in the ring to do that, but I'm not sure I'd be the best choice. But my point being is like that's sort of what Figure does in its asset class, and we will ultimately do that for Brex, Ramp, and for that asset class too. And it would be like new entrants that probably would be most interested until we got to the scale where somebody like a Brex would say, okay, this is interesting. That's just how disruption works, right? In mortgage, we started at the low end of the market and we're working our way up. In crypto-backed loans, which we are a big player in as well, there is sort of no incumbent market there. So it's just different. But, that's the dynamic.
How many years from now do you think you would be servicing someone like a Brex, Ramp, Rippling, and Navan?
Yeah, I mean, look, specifically there, I do think we'll be in all asset classes in, call it the 5 to 7 year timeline. I don't think that is an area where I would focus.
Yeah, I don't think that's like your next step. Yeah.
Right. Just because I mentioned like what's more adjacent SMB, like there's a lot of things that are more adjacent and more in need, but it is an asset class that I know. But I think at the same time, those players probably say like, this isn't our biggest problem. Whereas there's tons of people who are like, this is our biggest problem. Right. So, yeah.
So for your next phase, would you be focused more on retail or institutional adoption? Institutional?
Yes. I think for our next phase, at least for Demo Prime, institutional is going to get us what scales. We launched on retail, just like in our mortgage marketplace, we have a direct to consumer. That's super important to us. You need to vet things out. One thing I learned at Brex, running BD is like, you can't get partners to do what you don't do. You can, but it's very difficult to, when something is already working, people are much more excited about it. I think when you're like, oh, it's going to be great, like, try it. People are like, yeah, sure. And so
the sales dilemma, like you, especially at early stage, you have this idea of what it's going to be in 1 to 5 years, but it's not there yet. So people have to take the bet on you. Yeah,
exactly. What we did, so we launched Demo Prime on retail and then we added institutional and we'll continue to scale with institutional. To Mike's credit, I think he's been, SoFi also started that way in the beginning, right? SoFi was actually retail capital markets and moved to institutional. And I think, that's just something that he has done and I've learned from him to do. So I think the retail base will always be important, but to scale, if we want this to be big and dominate the whole private credit ecosystem, which we do, then we're going to need to use institutional as well.
What's going to be your biggest challenge in getting there? And what's the biggest challenge you've conquered so far today?
I think the biggest challenge in getting there for Demo Prime is going to be selecting the assets that come on, right? Like which categories and who, because this from your time in fintech, like sure, there's lots of people who want to borrow money, but it's like, do you want to give them money? And obviously we're not giving our money. It's the marketplace, but similar to how I said, we took credit sort of out of the equation. I think it makes it easier to grow and then you can add more risky stuff. But like when risk is not a huge factor, you can sort of change the market. So I think that's going to be the hardest thing. In general, what's the hardest thing that Figure's done? I think it's the homogeneity, like the common marketplace terms. So many, and you know this, both directly and indirectly from reading all these like forward flow agreements that SoFi and Upstart and everyone's signing. It's like there's a lot of money out there in private credit with a lot of smart people, and smart people like being smart. And so they like saying like, we're going to buy this box and do it this way. And like, we know, and they're paid to know, right? And we say, no, you buy the Figure platform, right? You don't get to like come and pick and choose. And that has brought that homogeneity, that standardization, that liquidity, and that's very hard to do. No one has done that.
Yeah, why do you think you guys were able to do it? And I'm sure you got pushback from everybody along the way. Like what made it so they still ended up using it?
I'd say it's a combo.
And how long did it take you to be able to do it?
It took about 7 years, right? I think it's a combination of Mike Cagney has a really unique ability to kind of see how the future could be. And I think that you take someone like myself and others at Figure, but I would put myself in this category for sure, are like able to take that and compromise with the ultimate goal. I think if you're too much of a purist and you're too religious, you'll get nowhere, right? And I think we've been appropriately pure and religious and then gotten more so over time as we had market power. And I think you just have to have experience to kind of know what to give on and what not to give on and when and for how long and how to change that. And I think we've been very deliberate, which takes time, and it does build this impressive moat. And that's one of the reasons why when I started to figure out what was going on and what could be as I was looking to join, I was like, okay, this is good. This could be good. So I kind of it really clicked for me, and I saw that opportunity.
Thinking more broadly about the entire on-chain lending space, what are some of the bottlenecks that you think are most important for us to fix?
That's a good question. I think more broadly, you have just a lack of liquidity, and you have a origination process that is divorced from a capital market, right? And those are sort of the same thing. But like if you think about your standard, and I always talk about fintech because that's what you know. So from a fintech perspective, when you're getting started, and then this just manifests as you grow, you're kind of like, okay, I'm doing this thing that I think people want, but I don't necessarily know that people will buy. Like I can get a borrower, I can get consumer interest, whether that be in the business context of, Brex, but also, in an individual context. But I also need something that I can sell because I have limited capital myself. I'm not a bank, right? And there's this huge rise of non-bank origination, capital markets, private credit that's growing rapidly. Back to when you're not reading forward flow agreements, you're of course reading about the rise of private credit, I assume. Mm-hmm. Because of all this is happening, you have originators or fintech companies or whoever they are, right? However they identify, they have assets they need to sell and they're not sure that someone's going to buy them. And you sort of live and die by that. It's existential. And the fact that there's no standardization, there's no guaranteed liquidity, you're sort of like always wiring money, receiving wires, sending out loans, building spreadsheets, that whole thing is kind of the biggest problem. And that's what we're roughly going after. And that's what blockchain can make better.
Stepping out more broadly to fintech, you've been early on so many different things, whether it be joining company or you invested in a Figure really early, even though you didn't join right away. It just wasn't the right timing, obviously. But what excites you in fintech today? What are some of the next big things that you see, 5 to 10 years from now are going to have made the biggest impact?
I feel very vindicated in fintech today because I feel like there was a period in 22, 23, where everyone was like, ooh, I hate fintech, right? Like rates rose and like no one cared anymore and people moved on. And everybody moved on, quickly to AI. But what actually happened, and there was always this idea that like SaaS, which I just don't like SaaS. I'm not interested. Anyone who actually knows me knows I'm just like, ugh. And when Brex was like, oh, we're like going to become this SaaS company, I was just like, ugh. I said to my wife, I texted her right away, and I was just like, oh my God, I hate
That's the real reason you ended up leaving, is they wanted to become a SaaS company, and you're like, no,
actually, I would say, like, ultimately, that you could boil it down to that. Yeah. Like, I think I felt like my skill set and what I could bring wasn't as much aligned with the future of where they were going. And so I was like, I think that I have like these abilities and like Brex has these needs and like I think I'm talented and Brex is good. So there's like some overlap with that, but it's not enough. And so I should maybe go elsewhere, actually. So yes, actually. And now I feel like, and Brex is insulated from this, as are many fintech companies, because it's actually hard to do fintech, right? You have money movement, you have regulatory, you can't just like go unlovable and just like start moving people's money around, right? Versus like you can build some applications that can do a lot of things that are software. But once you start hooking up regulatory, money movement, for frankly, many of the things that we're having a conversation about today, as I once said, like you can't AI your way into a AAA rating, right? Like you need to have results and performance and buyers and all these things. And so I think fintech is like hot again, at least in my mind. I mean, it was always hot for me, but I feel like now it's coming into the conversation when people are looking at AI. And I think people are appreciating the intersection between AI and fintech, because a lot of the most successful fintech companies, like if you look at Square, was probably the best and earliest example. It gave away software for free to earn a fintech revenue stream with merchant acquiring. It gave away sort of inventory management and restaurant management software, and was like, software has no marginal cost. And like that's actually even more true today with AI and software development. And so because of that, I feel like everything is sort of exciting in fintech again from that vantage point. Whereas I maybe would, not to hate on SaaS, like lots of people have made lots of money in SaaS and they probably, think I'm a loser. But I just think that like that's a big opportunity for fintech right now.
All right, let's close it out with, what is the biggest misunderstanding or misconception that people have about Figure?
I think that Figure, I don't hear this today, but like Figure has tried a bunch of things. And I think that people could interpret that as Figure is not focused. Whereas I think when you want to change how markets operate, sometimes you have to do things that may seem off-piste or orthogonal, to use a word that people like, but actually they're purposeful. And I could give a few examples, but like as an example, Figure built its own equity management software, meaning like a competitor to Carta. And if you were on the receiving end of like an outbound email for that, you could be like, what are they doing, right? But what you wouldn't know is that, well, in order to create like blockchain native equities, like tokenized equities, which has now become super hot, you actually need to have the authoritative copy, be generated that way. And so things like that, Figure has tried a bunch of things. And, you could sort of quibble about like, was that the right ROI, whatever, but more being that it doesn't imply a lack of focus. And I think that it could be like maybe more than you needed to do, or we could have stopped part way and, done more like iterate, et cetera. I'm not saying Figure is perfect and the execution has been perfect. Of course it hasn't. But I do think that what can seem as very different strategies can be part of this overall kind of blockchain-based marketplace tokenization that we've been talking about.
Right. I lied. I have one more question. Is there anything that Figure could do with stablecoins, since that's such a hot topic right now?
So we do things with stablecoins, and I mentioned that sort of like settling loans in atomically. And we actually do have our own stablecoin, which is called Yields, YLDS. It's a bit different.
Oh,
because
that's right. I forgot that.
It's an S1. It's a security registered with the SEC. It has an S1. So it's programmable like a stablecoin. It's peer-to-peer transferable like a stablecoin, but it can offer yield because it's sort of a tokenized money market fund. It's an interesting hybrid. And if you think about our capital market, I call Yields the oil of our capital market, meaning it kind of like moves throughout. And the fact that it accrues yield is valuable in settlement collateral. It can be used on exchanges. So it's a big innovation.
Yeah, that's interesting in that I know one of the biggest debates about stablecoins in general is like whether they can or will offer yield or not, since obviously you almost certainly have to be a security. So the fact that you guys have already done one that is a registered security and does offer yield maybe points to the future a little bit.
Absolutely.
Thank you, Michael. This was so fun to have you join me. I feel like I learned a lot about Figure and some of your new products today. I'm sure you guys have a very exciting future ahead, and we'll have to have you on again very soon.
Thank you. Appreciate it.